Welcome to this week's episode of the Vancouver Life Real Estate Podcast and YouTube channel. Today, we are extremely excited to present one of the biggest interviews we've ever hosted to date. Because in today's episode, we are deep diving into the world of economics and financial forecasting with none other than Mr. Doug Porter, the Chief Economist at the Bank of Montreal.
Doug is a luminary. With over 3 decades of experience analyzing global economies and financial markets. As the chief economist at BMO Financial Group and the mastermind behind the influential publication Talking Points, Doug not only shapes the macroeconomic of financial market forecasts, but also leads a team celebrated for its precision in forecasting, clinching the #1 spot across notable awards and surveys.
From starting his illustrious career at the Bank of Canada to becoming a revered voice in economic commentary, Doug's journey is nothing short of inspirational. His insights have not only earned accolades, but have also made him a sought-after commentator in the press and on the air for publications including Bloomberg.
Stay tuned as we explore the mind and motivations of the man who's been at the forefront of economic forecasting, offering a rare glimpse into the intricacies of financial markets and what it takes to lead a team to the pinnacle of success in the challenging world of economic analysis.
So one quick note before we get started here. Of all the episodes we've ever done, the tech gods decided this was the one to create some technical issues. So just be aware that the answers that Doug gives to questions 2 and 3 are cut a bit short. So we apologize for this in advance, but don't worry, it's largely smooth sailing right after that. And believe me, you will get a ton of value from this interview. Doug is an immense wealth of knowledge, and he provides incredible insights into what you can expect in 2024 for our economy across Canada, as well as our housing market. Now, let's dive right into our interview with Doug Porter. Okay, and here we are with Mr. Doug Porter, the Chief Economist with the Bank of Montreal. Doug, thank you first off so much for being here today. We are incredibly excited for this interview. Let's dive right in here. So I think off the top, let's start by having you share a bit of a state of the union as to where the economy in Canada is today and maybe a bit of your projections for 2024.
Okay, and first of all, thanks for having me. It's a real pleasure. So I always like to start off with something positive, and I think the major positive is, look, we've seen inflation come down a lot in the last 18 months, and it hasn't required a recession to get it down there. I mean, when you think back to the summer of 22, we were looking at inflation of over 8%, and now we're close to 3%. And, we got there without too much economic pain. We haven't had an outright downturn in the economy. And so I think that is good news. Looking over the next year, let's face it, the big question is, can we get inflation down a little bit further and still achieve a soft landing? I would say that if we start in the United States, I think we are looking at a soft landing there. Some people have even talked about, the possibility of no landing for the economy. There are some signs that the U.S. economy is actually reaccelerating to a small extent. Closer to home here in Canada, though, I would not call it a soft landing. We are going through a little bit of a bumpy stretch here. We've seen really little growth in the economy over the past 9 months or so. I would not call it a recession, but it's been close. I mean, the economy really has struggled to grow in the last 6 to 9 months. I think that's going to be the story in the first part of 2024. I think we're looking at very modest growth at best, simply because the economy is still digesting those big interest rate hikes of the last couple of years. I don't think they've fully worked their way through the economy. So I think, if you look at our point estimate for the economy this year, we're looking for real GDP growth of 0.5%. That's very modest, and especially when you stack it up against the fact that we've had very robust population growth in the past year, that's quite modest growth. Now, I do think that does, and we're going to get into the interest rate outlook a little bit further later on, but I do think it sets the stage for the Bank of Canada to start to turn the tide. I don't think it's coming quickly, but I do think by the second half of the year, we're going to see a series of rate cuts because we have seen inflation come down a lot. They do want to get it down a little bit further, but we think we're getting close enough that we can start realistically talking about rate cuts, and growth is weak enough that we can start realistically talking about those interest rate reductions. And the final thing I would point to is, and one of the reasons why they will be cutting interest rates, is growth has been weak enough that we've seen some underlying deterioration in the job market. I mean, when you think about where we were a year ago, we had an unemployment rate of about 5%, which is exceptionally low. But over the past year, it's risen to 5.8% and probably headed higher over the next 6 months or so. Not dramatically higher, but we do see it moving into sort of the 6 to 6.5% range over the year ahead. And we think, again, that's soft enough to set the conditions for rate reductions later this year.
Thanks, Doug. So, obviously with inflation dominating the headlines, and we know that the Bank of Canada's target is 2%. Is there a world where 3 and 4% are the regular, and are the days of 2% gone?
So I would say the short answer is that the days of 2% inflation are probably not gone. And what I would point to, I'm often asked the question, by the way, is a 2% inflation target achievable? Is it realistic? The thing I would note is that since the Bank of Canada began targeting inflation back in the early 1990s, centuries ago, actually just a little bit more than 30 years ago, inflation has actually averaged just a snick above 2%. And of course, in the decades before the pandemic, inflation was actually averaging a little bit below 2%.
Doug, just kind of a bit of a follow-up to what you were just mentioning with respect to it being a little bit more difficult to go from 3% down to 2% inflation. Do you think that's largely based on the fact that the circumstances before the pandemic have drastically changed compared to where we are now? So much so as we've got, 2 million more people in the country. We don't have any more housing supply to really have helped with that level of immigration. And I'm just wondering if it's still realistic for the Bank of Canada to propose that, given that the circumstances, in my opinion, feel like they've changed to some degree. And if they are, is it worth it? Or is there a scenario where we could see this, 2.5 or 2.75% kind of be the new norm? I would imagine that would mean that some prices would remain elevated going forward too.
Yeah, and so keep in mind the Bank of Canada resets their inflation target every 5 years. The last time they did it was actually in late 2021. So the next time it'll be up for issue is 2026. I actually think that's going to be a good debate at that time, whether 2% is still appropriate. And the answer may well be, no, it's not. That maybe 3% is the right answer. I think that's probably a good time to have that debate at that point. In terms of getting down to 2%, so one thing I will say, working in our favor, is the single biggest driver of inflation right now is mortgage interest costs. They're up almost 30% in the past year. They're the single biggest element that's adding to headline inflation. They're actually adding almost a percentage point to inflation. Now, when mortgage interest rates crest and start to come back down and are more moderate, the effect's going to work in the opposite direction. Now, it's going to take a little bit of time, but I think when we get out into 2026 and 27, we're actually going to find that mortgage interest costs are helping us keep inflation lower than it would have otherwise been.
Given the ongoing discussions about housing affordability, what are your thoughts on potential regulatory changes to amortization? Is this something you see changing in the future to help people, qualify and also have lower payments?
So I don't believe so. I think an increase in amortization is sort of a short-term solution when we think about affordability. It can help over the near term. But the reality is if you increase the amortization lengths, what that would probably do is ultimately, give a short-term boost to affordability. It might pull more people in the market. It might ultimately increase prices to some extent, and you end up in more or less the same place than you began. I see that very much as a short-term solution. I wouldn't completely rule it out. The other side of the equation there is I don't believe the regulator is particularly interested in changing the rules. I could see them, look, in some circumstances, quietly encouraging almost like a soft increase in the amortization, but I don't see a full scale change on that front, frankly. If anything, the appetite for the regulator has been to go the other way, to tighten it, to make things a little bit more difficult, frankly. So I doubt that's one of the realistic solutions out there.
Doug, as we saw when rates initially came down, or when we started doing, when we started raising interest rates back in 2022, the Bank of Canada kind of led the way out of lockstep from the U.S. Where we are now, the US appears to be poised to withstand sort of a higher for longer interest rate compared to Canada. So, do you think that Canada is in a position where we would cut rates ahead of the US? And if we did so, would that have an adverse effect on our dollar? The US is definitely more capable, I think, of withstanding a higher debt load, a much bigger economy. There's a lot of factors at play there. But I'm just wondering if, and our economies are so closely tied together that they typically move together. So just wondering if you think that we should be looking to the States for the first cut, or do you think it'll happen up here in Canada first?
Okay, so now we're getting into the real heart of the issue, I think. Fundamentally, look, our official view is that we believe the Bank of Canada is going to lead the Fed on the way down. It's not what's priced into the market. The market actually is much more aggressive in terms of Fed rate cuts. The market's actually looking at the possibility of a Fed rate cut as early as March. We're not big buyers of that view. We think it's going to take a little bit longer for the Fed to start cutting. But we see the Bank of Canada starting in June. That's actually close to market expectations for the bank, and we're relatively comfortable with that view. For both central banks, we do see them cutting by 100 basis points this year, but we think there's a case, a pretty good case, that the Bank of Canada is going to lead, and potentially they could be a bit more aggressive. And fundamentally, it's just because the higher interest rates do dig deeper for Canada because we have a much more indebted consumer. That debt turns over earlier and faster than it does for U.S. consumers, and we've seen the economy suffer under the weight of higher interest rates much more than in the U.S. So, outside of the political issue that the Fed might feel like they have to cut ahead of the election. That's about the only reason I can offer for the Fed going earlier than the bank. So again, our official view is that the bank will actually lead the Fed by a little bit. Now, what does that mean?
Mm-hmm.
I think there is the possibility that it can undercut the Canadian dollar a bit because the market's really not expecting the bank to lead the Fed at this point. I don't see a big move because we don't see a lot of daylight between the bank and the Fed. Just as on the way up, look, yes, the bank led the Fed by a little bit initially, but the Fed got up pretty quickly. And we think it's more or less going to be the same story on the way down as well. The bank will initially lead, we think, but ultimately we think the Fed will catch up. So whatever, downward bias there is on the Canadian dollar, we don't think it'll last long.
Got it.
And
Well, really appreciate you answering that directly because we know that's one of the biggest topics on the minds of many here, especially across Canada. And so, what I'm gathering, what I'm hearing too, is that essentially, based on our economy today, we are in a restrictive interest rate environment. And if I'm right in that proclamation, what range would you say is the neutral rate, and when might we expect the BOC to land there?
Well, the beauty is the Bank of Canada is actually very forward in terms of what their so-called neutral or natural rate interest rate. They lay it out for all to see. Once a year, they make an official call in terms of what they view as neutral, and their official view is somewhere between 2 to 3% on their overnight interest rate. And just as a reminder, the overnight target right now is at 5%. Um, Economists haven't always agreed with the Bank of Canada and what they see as neutral. In fact, before the pandemic, I would have argued that neutral was actually a little bit below 2%. If you think back to the decade before the pandemic, the Bank of Canada was never able to get their overnight interest rate as high as 2%. Ever since the global financial crisis, right up into the pandemic, the highest their overnight interest rate ever got was 1.75%. And to me, that suggests anything above two was actually in restrictive territory. But that was then. As I
Mhm.
said earlier, things have changed a bit as a result of the pandemic. I actually happen to subscribe to their view of where neutral is now. I actually do believe it. And in fact, I would actually peg it towards the upper end of their range. I think neutral is somewhere between 2.5 to 3%. So versus today's levels, about 2 percentage points or a little bit more below where we are today. And so those are the kind of interest rate cuts that we could foresee over the next couple of years would be a little bit more than 2%.
Awesome. So, a lot of people that are starting to enter the market are looking for opportunities, and usually outside of BC, as it's very difficult from an investor standpoint to earn cash flow on condos and investment properties. Is there a particular province or city that you see as has the best growth for 2024 and 2025?
So if we look in the rearview mirror and use that as a little bit of a guide, it's almost like, we're running the Kentucky Derby and Calgary has been the secretariat, miles ahead of everybody else. It's very interesting when we look at the percent change in home prices nationally since they peaked back just before the Bank of Canada began raising interest rates in early 22. Calgary home prices have actually risen since that point. Everybody else has seen declines, especially in Ontario. Ontario's seen deep declines. Places like Vancouver, Halifax, Montreal, they've seen modest declines, and Calgary has gone the other way. Looking ahead, and I know the past is not always the future, but looking ahead, I do have to favor Alberta still at this point. I think they're probably the horse to back at this point to keep the Kentucky Derby analogy going. Look, Alberta's got the strongest population growth at this point. They've still got a fundamentally solid economy, I would say, based on the level of oil prices. And their affordability is still reasonably good compared to, say, BC or Ontario. So I think most signs still suggest that Alberta's got some of the best potential, at least over the near term to the medium term. Looking a bit further afield, I hate to say it, but I actually think the GTA might be next in line. And the GTA and some of the surrounding Ontario cities have actually been beaten down the most in the last couple of years. But look, Ontario's still got very, very robust population growth backing it up. I believe there actually is a lot of pent-up demand in Ontario. Now, this might not so much be a condo story. This might actually be more of a single family detached story. But I think, if you look to what province could or what area could bounce back a lot as interest rates come down, and it might not be immediate. This might be a story for more 12 to 24 months out. But I would actually look at the GTA as being another potential area that could spring back a lot. The third area I would point to, a slightly different story, and sort of the dark horse is Atlantic Canada. Look, for decades, Atlantic Canada was a bit sleepy, frankly. They had very little population growth. The markets tend to be pretty quiet. In recent years, the population has found Atlantic Canada, especially the three maritime provinces. And we're seeing very robust population growth in places like PEI and Halifax as well. And so I think that's another, and when you look at the levels of prices there, they're relatively low compared to, say, a Western Canada or Ontario. So that's another potential spot that I would favor.
Wow, very interesting. And I mean, Alberta's been low for a long time, so it's been nice to see it have a bit of a run. It's been like 7 or 8 years there where prices just didn't move; they were flat for a long time, and that I think was largely due to the price of oil, amongst other things. But I guess with all of these interest rate hikes, the fact that we accelerated at such a pace, Canadian real estate, I think, in many ways, continues to surprise many with its resiliency. I mean, we're 2 years here into a rate hiking cycle with multi-decade high interest rates, and yet the mortgage arrears rate that we see across the nation sits at almost all-time lows at just 0.17%. In your opinion, what do you think Canadians are doing to maintain their payments on their mortgages? Where are they cutting? And how much longer do you think they actually have before we start to see that arrears rate potentially change in a negative way?
So very, very interesting. If we stand back and look at a really big picture, look, one of the big surprises of the past year is how resilient the global economy, the U.S. economy, the Canadian economy have been in the face of higher rates, and a lot of it does go back to the consumer. And just circling back to the U.S., for instance, I would say a lot of spectators have been amazed at how well the U.S. consumer has hung in there in the past year, and to a
Mm,
lesser extent, the Canadian consumer as well. And I think when we stand back and ask the question why, it's because consumers did a very good job of setting aside a lot of savings during the pandemic. We came into this with a lot of talk about so-called excess savings that people had built up,
mm,
and we didn't know how that was going to play out against the terrific rise in interest rates we saw in 22 and 23. And I think we have our answer now, is that the excess savings won. They were able to overcome, and that goes for Canada as well. I think the buildup of savings that we saw during the pandemic and in the early aftermath. I think to some extent households were preparing for what they knew was coming in terms of higher interest rates. Overall, household finances actually improved a lot during the pandemic. That's one answer. Another answer is that the job market has still remained relatively healthy. I did talk about the
Mm,
unemployment rate rising, but the Canadian economy actually added over 400,000 jobs last year. In a normal year, that would be really strong.
mm,
And while the unemployment rate has risen, it still is relatively historically low. Like a 5.8% unemployment rate is actually well below its long run average. So most people still have jobs. They're still able to meet their mortgage payments. And I guess the last thing I'd say is income growth has actually been pretty solid as well. The Bank of Canada they wring their hands at the fact that wages are still rising 4 to 5%, but the reality is the average household is loving that because they're actually seeing their incomes now rising faster than inflation, and I think that's helped them keep their head above water. Now, having said all that, the reality is that we have started to see insolvencies get back to normal at the consumer level, if not even rise a little bit above pre-pandemic levels in recent months. And I do think that we're going to see strains begin to worsen a bit more over the next year. The longer we stay at this kind of level of interest rates, a lot of those positives I talked about earlier are starting to wane, but the interest rates are still there. And so I do think that slowly but surely we will see that vice grip a little
mm.
bit tighter on the household sector in the year ahead. I think you are going to start to see a few more delinquencies. I think you are going to start to see those insolvency numbers rise. Not like we see in a typical recession or a downturn by any means, but I do think that the strains will build a bit as we go through 2024.
Yeah, we certainly hear the stories of people on variable mortgages or a lot of people who have renewed that it is a bit of a payment shock, understandably. And I think today nationwide, we're sitting around 45 to 50% of all existing mortgages have seen a payment increase. But there's a lot of talk and even a buzzwords come out of it, known as the renewal cliff, which is, of course, referring to the large portion of Canadian mortgages that are due to renew in 2025 and 2026. I think in preparation for this, we've been hearing stories of the major banks ramping up their loan loss provisions for this potential, I guess, spike in potential non payments. In your view, how real is this threat or potential threat of the so called renewal cliff?
Yeah, I know some of our competitors made a big deal about this, fretting about 25 and 26. I'm actually worried about 2024. And first of all, when we stand back and look at it, yes, there are a few more mortgages coming due in 25 and 26, and the change in rates from, where they locked in is potentially, that's where we'll see the peak differential. But if you think back to, when I spoke about our interest rate forecast, I think by 25 and 26, certainly, we're likely to see borrowing costs come down a lot over that time frame. So I'm actually not that concerned, especially when we get out into 2026. I'm more worried about what's going to happen in the next 12 months. The people who are renewing now took out, say, in the spring of 2019 when rates weren't as low as they got during the pandemic, but still they were fairly considerably below where we are now. I think actually this is the year to be concerned about before rates really start coming down in a big way. So I'm a bit more concerned about this year. I don't think there is a big cliff coming in 25, 26. Like I said, I think we'll find that borrowing costs have ebbed a lot by that point because inflation will hopefully be under much better control. So I actually think the challenge is in the here and now, right now. Um, just to put in perspective, though, you talked about a spike in the provisioning. Look, they're preparing for some moderate deterioration in household finances, but I wouldn't characterize it as a spike that we're looking at. We just are looking at look, we had exceptionally low delinquencies and insolvencies and bankruptcies during COVID in 2021 because people were so very well supported. We're kind of just getting back to normal and maybe a little bit worse over the next year as a result of the ferocious backup in interest rates that we've seen.
Fantastic. So, a quick follow up on that one. There's some people who believe or use the term that housing is the economy within Canada. And of course, we look to our partners down south in the States where their economy is essentially, well, the stock market or the banks, right? And we've seen their banks get in trouble. And guess who rushes to bail them out? Of course, their government. Hypothetical, just to play this one out for fun. If housing got in real trouble in Canada, it dropped 40, 50%, for example, could there be a world where the government would step in and do something to prop it up if they're not already?
So first of all, I think if we saw a really dramatic pullback in home prices, look, that would point in the direction of a very severe drop in inflation as well, and you'd see the Bank of Canada alone getting quite aggressive on the interest rate front. And to be clear, I don't think the Bank of Canada targets the housing market per se, but to your point, it is such a large part of the economy, and it's a it's a major swing factor for the economy overall. That ultimately, how housing fares will play a big role in terms of how the Bank of Canada sets policy. In fact, I would argue one of the reasons why the Bank of Canada went back to the tightening wheel last summer is that they were a bit shocked that housing picked itself up and starting perking back up last spring and summer. I think it's actually one of the main reasons the Bank of Canada began raising interest rates again. So on the flip side of that, if housing got into very serious difficulties and we were looking at a deep decline in home prices, that would feed through into the broader inflation outlook, and you would see the Bank of Canada cutting interest rates aggressively. Look, my own view, and I hope I'm not insulting anyone here or offending anyone. I think housing is the new religion in Canada, or real estate is the new religion. There is an army of potential investors out there who are going to step in if the market ever sees a serious correction. We've had a multitude of calls over the years about the housing bubble popping. I actually, whenever I gave my presentations about 5 to 10 years ago, I used to have a long list of calls people had made each and every year for about a decade, calling for the coming collapse in Canadian housing that never ever happened. Um, of course, you can never say never. I actually did live through the very severe downturn in Canadian housing in the early 1990s, when prices in Ontario fell by more than 25% in a relatively short period of time. That did not generate a bailout. It did ultimately lead to much lower interest rates, and it took a long time for housing to turn around in Ontario after that. But it did turn around, and it's amazing how quickly people forgot that very serious correction that we went through, especially in Toronto and Ontario more broadly in the early 1990s. So, I don't rule out a pretty serious correction, but we have just been mightily stress tested in the last couple of years
Mhm.
with that backup in interest rates. And what was the worst that it got was a 15% decline nationally after we'd seen a 50% decline 50% rise, I should say, in the 2 prior years. That's a pretty minor correction in the grander scheme of things.
Doug, I've got an interesting question. It's kind of to some degree on the flip side of what we were just talking about. What I learned during the pandemic was just how connected all of our supply chains were around the world. It was one of the and I think even to throughout the pandemic and beyond the pandemic, I think it's even relying even heavier on it. Like my wife orders an amazing amount of things from Amazon that just
Oh,
continue to
yours
show
too.
up. And what I think is there's other macro global economic factors taking place right now, such as what we're seeing in places like Yemen, the Red Sea, where these supply chains, even supply of oil, could be disrupted if these regional conflicts get worse. Is that is there a scenario, one where the Bank of Canada doesn't look to cut interest rates because of global affairs? And in the event, if we do get another supply chain disruption, what do you think generally the impact on our economy would have, or what would it have in terms of the impact to the average person, much like it did through the pandemic?
So if we step back and think about what happened to the supply chains in 20 through 22, let's say, I think that was a very unique set of circumstances that hit us all at once. And by the way, we were very much of the view that it was not just a supply issue.
Mm.
If you think back to the dark days of 20 and 21, you really couldn't spend on services. It was very tough to travel or to go see a movie or a show, or go to a Leaf game or a Canucks game, even if you wanted to. It was tough. So people really were locked in and were basically spending on goods. I actually think it was as much a demand story as a supply story.
Interesting.
We had a tidal wave of demand for goods. And by the way, American consumers in particular were supercharged by the stimmy checks and all the support they got, which I doubt we're going to see again. Um, and that washed up against a number of supply chain issues that all happened at once. I think that was a unique set of circumstances that's not going to be repeated. What we're seeing in the Red Sea, and by the way, the Panama Canal is having issues of its own
Mhm.
because of low water levels.
Environmental
That
ones, yeah.
that's a concern. It's definitely not a step in the right direction, but I just don't think it holds a candle to what we saw in 21, 22. Look, I've learned better than to dismiss anything that clogs up the supply chains and leads to cost pressures. It's obviously not a move in the right direction, but that's not really where inflation is being driven these days. It's not in goods. It's not in things like furniture, appliances, clothing, electronics, autos. Most of those prices have stabilized. It's services and housing and shelter that's really driving inflation, and that's true globally, and it's definitely true in Canada. And so while the issues in the Red Sea, they're talking about it maybe leading to a couple tenths of a percent of inflation. That's obviously not where we want it to go, but I don't think it fundamentally changes the inflation backdrop. And I'm not especially concerned that we're going to have the same supply chain issues. I'm more concerned about, say, the ongoing pressure from rents and wages. I
Mm.
actually think that's the bigger challenge.
I mean, clearly we are in uncertain times, as we often always are, and there are inherent risks and headwinds for 2024. But I'm also curious, is there another side? Is there opportunity that you can foresee this year, whether it's in specific industries or certain areas of the economy that you'd be open to sharing with us?
Well, again, I think the big surprise over the past year is how well the U.S. economy in particular, but the global economy more generally did. Just recently, the IMF actually quietly upgraded their forecast for the global economy. They're looking at better than 3% growth this year. That's barely below average. And I do think that the financial markets are sending us a pretty important signal. You can't always trust the equity market and the bond market to give you the exact right answer. Sometimes it does send false signals, but it's more right than it's wrong. And we've seen a very steady recovery in equity markets from the lows they hit way back in October 22. Just recently, the S&P 500, the Dow have actually been at record highs.
Mhm.
The Toronto's market is getting close to almost being back to a record high. To me, that's not flashing warning signals at all. If anything, it's warning that the surprises might actually be to the high side for the economy. And what, of course, what's leading that charge has been tech, anything related to AI. But more generally, I think it is sending a message that the tech sector actually might continue to thrive in this environment. It's managed to deal with the interest rate increases we've seen so far. It's not really an interest sensitive sector, anyways. And so I think that's one area that might be supportive, and yeah, that's even true here in Canada. I think also we have to look a bit at the resource sector. Look, I know there's a lot of focus on oil prices, but even a lot of other resource prices are hanging in there quite well. Of course, we got this big drive to decarbonize and to move to electric vehicles in particular, and we mine a lot of that stuff here in Canada. So I think the mining sector in general is one area that could fare well in the years ahead. I guess the downside of that I would just point to is if we get another high side surprise in the economy more generally, it's going to be tough to justify really aggressive interest rate cuts. And so you got the good news of the underlying economy is doing well and sort of supportive of the real estate market, but it's where's the argument for really slashing interest rates if the economy is still chugging along? And I actually do see a scenario where the Fed and the Bank of Canada may cut interest rates this year, and then find that, hey, look, the economy is still sailing along, and we actually get rates starting to back up in 2025. I don't rule that scenario out. Look, it's
Oh.
it's not our base case forecast. We think actually rates do come down a little bit further in 25, but it's a realistic scenario
Mm.
that the central banks might actually stabilize and even bump interest rates back up a bit in 2025 if the economy remains on wheels, especially in the US.
Very interesting to hear, because it's funny. Every headline that we seem to hear talks about how Canada's either in a recession or on the verge of a recession. And it does sound like that there could be a significant shift in that direction. So, or to shift away from that, I should say, which would be great. Honestly speaking, it would be great for everybody to have a little bit more money and for everyone not to lose their jobs and potentially for, that job rate to stay where it is. I think that would be ideal. Given everything we've talked about today, I'm fascinated to see, because a lot of people have all of their own different perspectives of what's going on and what's going to happen in 2024. And I feel like I've learned a lot today, Doug, and you put a lot of my fears and quashed them a little bit, which I think a lot of people need. So thank you so much for that.
Oh, it's my pleasure. And by the way, I know our team has won a lot of forecasting awards in the last couple of years. I would just say that just means we've been less wrong than other people. We all know we all know we're going to be surprised over the year ahead. It's, you just want to minimize those surprises. But realistically, ever since the start of COVID 4 years ago, it's pretty much been one surprise after another. And I think
Yeah.
we have to be nimble in this environment, and realize that that the consensus can be dead wrong.
Yeah,
But
exactly.
thank you for having me.
Of course. Yeah, we appreciate it. Congratulations on the award for being less wrong than the others. That is a noble pursuit. And we immensely appreciate your time today, Doug. Thank you so much. This has been incredibly enlightening. We know we're going to get a lot of questions and a lot of value out of this one from our viewers. So thank you once again.
Okay, appreciate the opportunity. Bye now.
Of course.